The July jobs report came out on Friday, and it painted a much weaker picture of the labor market than investors had expected. For the stock market, that weakness was actually viewed as positive because it reduced the chances of the Federal Reserve raising interest rates again in September. For American workers, however, the report was much more concerning. Economists had expected the labor market to add around 83,000 jobs in July. Instead, the report showed a loss of roughly 23,000 jobs. That is a massive difference between expectations and reality. And the July number becomes even more concerning when you step back and look at the broader trend. Job creation has been gradually weakening over the past several years. The labor market was extremely strong coming out of the pandemic, but since then the number of jobs being added each month has generally moved lower. But the headline July number was not even the most concerning part of the report. The government also revised the May and June employment numbers downward by a combined 103,000 jobs. That means the labor market was weaker during those months than originally reported. This is important because investors and policymakers make decisions using the numbers available at the time. A report may initially show relatively healthy job growth, only for those numbers to be revised significantly lower several weeks later. That creates uncertainty over how strong the labor market actually is. The source goes even further and argues that the true July number may eventually prove substantially weaker than the initial estimate. That is speculation, not something established by the current report, but the repeated downward revisions are one reason skepticism around the headline numbers has increased. Then we get to another strange part of the report. Even though the economy lost jobs in July, the unemployment rate actually fell from 4.2% to 4.1%. At first glance, that appears contradictory, but the explanation comes from the labor force participation rate. The unemployment rate only counts people who are unemployed and actively looking for work. Someone without a job who is actively applying and searching is generally counted as unemployed. But if that person becomes discouraged and stops looking, that person can eventually leave the labor force entirely. Once that happens, the person is no longer counted as unemployed under the standard unemployment rate calculation. So it is possible for employment to weaken while the unemployment rate falls. If enough people leave the labor force, the official unemployment rate can decline even though the underlying job market has not improved. That does not mean the unemployment rate is fake. It means the number has to be understood correctly. The unemployment rate measures a specific group of people. It does not measure every adult without a job. That is why labor force participation becomes extremely important when trying to understand whether the employment situation is actually getting better or worse. Looking deeper into the July numbers, healthcare and social assistance were among the strongest areas of job creation, adding roughly 22,600 jobs. Construction and professional services also added employment. But several other industries moved in the opposite direction. Financial activities lost jobs. Retail trade weakened. Leisure and hospitality lost employment. And government experienced some of the largest job losses. So the weakness was not concentrated in one tiny corner of the economy. Wage growth is another part of the report worth watching. Over the past several years, wage growth has also been trending lower. In July, wages grew at roughly 3.2% from the level cited in the source. That is significant because the most recent inflation figure available at the time was around 3.5% for June. If prices are rising faster than wages, workers are losing purchasing power. A worker might technically receive a raise, but if that raise is smaller than the increase in the cost of living, that person can still afford less than before. A 3% raise does not feel like a raise if rent, insurance, food, utilities, and transportation costs are increasing faster. That is the difference between nominal wages and real wages. Nominal wages tell you how many more dollars someone earns. Real wages tell you how much those dollars can actually buy. The source argues that official inflation statistics understate the actual increase in living costs and points to faster money supply growth as part of that argument. That is a broader debate, but the central issue remains the same regardless of the exact inflation measure being used. If wage growth stays below the growth in household expenses, the average worker experiences a decline in purchasing power. That pressure becomes even more important when the labor market is weakening at the same time. People have less negotiating power when companies are hiring aggressively. Workers can change jobs. Employers have to compete for employees. Wages rise faster, but when hiring slows and layoffs increase, that dynamic reverses. Workers become more cautious. Companies face less pressure to increase compensation. And wage growth can continue slowing. Technology is one of the industries where that pressure is becoming particularly visible. According to the Challenger layoff figures cited in the source, technology has experienced around 149,000 announced job cuts so far this year. That does not mean AI is responsible for the entire deterioration in the labor market. It clearly is not, but the technology is becoming a larger part of the employment story. Companies are under intense pressure to show investors that they are using AI. Executives want lower costs. Investors want higher productivity. Businesses are experimenting with replacing certain tasks that previously required employees. Some of those experiments will fail. Some jobs will eventually return. Other jobs may permanently disappear. The impact will vary dramatically depending on the industry. AI is also still extremely expensive. Companies are spending enormous amounts of money on chips, servers, data centers, electricity, networking equipment, and software infrastructure. Many AI products have not yet generated enough revenue to justify the amount being invested in them, but that has not stopped the investment boom. In fact, AI spending is one of the major forces supporting the stock market and parts of the broader economy right now. So we have a strange situation. AI investment is supporting corporate spending and financial markets, while AI itself is simultaneously being cited as a reason for reducing headcount in some companies. That helps explain why the stock market and the labor market can tell completely different stories. And that brings us back to the Federal Reserve. The July jobs report was bad news for workers, but markets interpreted it as good news because a weaker labor market makes another interest rate increase less likely. Before the report was released, markets were pricing in roughly a 67% probability that the Federal Reserve would raise interest rates at its September meeting, according to the FedWatch figures cited in the source. After the jobs report, that probability fell toward roughly 52%. That is a major change from a single employment report. The reason comes down to the Federal Reserve's dual mandate. The Fed is responsible for maintaining price stability while also supporting maximum employment. If inflation is too high, the Fed has an incentive to raise rates or keep monetary policy restrictive. But if the labor market deteriorates too quickly, the Fed has an incentive to move in the opposite direction. Higher interest rates slow borrowing and spending. Businesses become more cautious. Housing becomes less affordable. Corporate financing becomes more expensive. Hiring can weaken. So if employment is already deteriorating, another rate increase becomes much harder to justify. The Fed now faces competing signals. Inflation remains above its long-term target. That argues for tighter monetary policy. But employment is clearly weakening. That argues for caution. One reason markets still see a meaningful possibility of another rate increase is that the unemployment rate itself fell to 4.1%. The Fed watches many labor market indicators, but the unemployment rate remains one of the most important. That creates a complicated picture. Payroll growth is weak. Previous months were revised lower. Labor force participation declined. Wage growth is slowing. Layoffs are increasing in some industries. But the headline unemployment rate still looks relatively low. That is why investors are divided almost evenly over what the Fed will do. Some economists believe the weakening jobs market is enough to stop another rate hike. Others argue inflation remains too high and the Fed still needs to tighten policy. The next inflation report could shift those expectations again very quickly. A hotter-than-expected CPI number would strengthen the argument for raising rates. A softer inflation report combined with weak employment could make another increase much less likely. My view is that the Fed will probably hold rates steady rather than raise them again in September. That is only an opinion, and the economic data between now and the meeting could change the situation. There are also political arguments surrounding Federal Reserve independence, and whether policymakers will feel pressure to avoid tightening financial conditions further. But the clearest economic reason for holding rates is simply that the labor market is no longer behaving like an economy that can easily absorb significantly tighter policy. And this is the strange reality investors now have to understand. A bad jobs report can cause stocks to rise. Not because losing jobs is good for the economy. Not because layoffs are somehow positive. Stocks can rise because investors immediately begin pricing in easier monetary policy. Markets care about liquidity, they care about interest rates. They care about the cost of borrowing. A weak labor market increases the probability that the Fed eventually stops tightening or begins moving toward easier policy, and easier financial conditions are generally supportive of asset prices. That creates a disconnect between Wall Street and ordinary workers. The person who loses a job experiences an economic crisis. The investor watching the same jobs report may see a reason to buy stocks because interest rates could stay lower. Both reactions can happen at the same time. That is why the July employment report matters beyond one monthly number. The labor market is clearly losing momentum. Wage growth is slowing. Labor force participation has weakened. Technology layoffs remain elevated. AI is becoming a larger part of the employment story. And the Federal Reserve is now being forced to balance persistent inflation against a labor market that is becoming increasingly fragile. The next few inflation and employment reports will determine which problem becomes more important. If inflation stays high, the Fed may still feel pressure to tighten. If employment deteriorates further, continuing to raise rates becomes increasingly difficult. For now, the market is beginning to price in the possibility that the weakening labor market will force the Fed to become more cautious. That may be good news for stocks. It is much less comforting for the people actually trying to find a job.